Okay, so there's something that's been driving me crazy for 10 years, and I can't restrain myself any longer from going on a rant about this subject. It has to do with the fact that traders who like to supplement their day trading with buying put or call options completely miss a really obvious point, and for the life of me, I can't figure out why they don't see it and act on it. It's sure to save you over time a great deal of money in commission costs with literally no downside. So if you're interested in a really easy concept to save yourself over time thousands of dollars in commission costs, then I'm pretty sure you're going to want to watch this video, so stick around. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a prop trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. You'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investing community. Now, in this video, we're going to be discussing a mistake that the smartest and most experienced day traders I know, for some odd reason, continually make. It has to do with the fact that if a day trader wants to make a long bet on the market, they'll frequently go out and buy SPY call options, or if they're bearish, they might buy SPY put options. Or they may have a large long position and they want to hedge it with SPY puts, or conversely, they may be short the market but hedge their positions with SPY call options so they don't have a disaster on their hands if the market bounces. I'm not quarreling with the impulse to go long or short the market or to hedge large positions. I just don't know why they don't choose to save themselves a ton in commissions by handling this the right way. So we'll get into that in a minute. Now, incidentally, we're running a free workshop right now for traders interested in learning 3 solid real-world option strategies that professional options traders use, including this really simple but effective strategy that great investors in the world, such as Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. If you're interested in all 3 of those strategies, you should check out the free options class that we're currently running. So just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window so you won't lose this video. You can also visit optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. All right, so let's get started. Now, most of you are probably familiar with index options, which are the options that we'll be using in this example, but there may be some who just have a passing knowledge of how they work. So I'm going to do a quick basic review of the basics so that you'll be able to understand how to implement this strategy. Now, for those experienced options guys out there, don't worry, this will be quick, and then we'll jump right back into the guts of the lesson. So you're probably all familiar with how equity options work. With equity options, and the SPY is technically an equity, a call buys you the right to buy 100 shares of a stock like SPY at the strike price of that option any time before the option expires, and a put option entitles you to sell 100 shares of stock like SPY at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except that there's no such thing as 100 shares of an index like the S&P 500, so you can't really buy or sell 100 shares of an index, but what you can do is get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So, for example, if the SPX index is trading at 3,000 and you buy the 3010 call, if the SPX goes to 3015, you'd receive $500 in your account. If the index closes at 3009 or lower, your call expires worthless. On the other side of the ledger, if you buy a 2985 put and the market sells off to 2975, you'd make $1,000, but if the market just sold off to 2985 or higher, the put would expire worthless. So those are the basics of index options. Okay, so let's say that you've decided that you're going to make a market call that the SPY will go up. In other words, that large cap US stocks are likely to rise. Let's say as a result of an election or a jobs report or whatever. So let's say in that process you decide to get long 10,000 shares of SPY at $300 a share for the day. But you don't want to lose more than $10,000 on the trade, so you buy 100 SPY puts at $2.99. Just to review, if you own those puts, then the put seller is required to buy your shares at $2.99 no matter how low the SPY stock goes. So effectively, your SPY shares can lose no more than $1 per share before the put kicks in. Since each put protects 100 shares of stock, you can protect all of your shares by buying 100 SPY $2.99 put options, as you can see from the calculation. So let's say those options will expire at the end of the day and that they're currently trading at 50 cents. Now, depending on the broker, you'll probably pay an average of about $100 per option, so you'll have expended $100 in commissions, $1 per option. Now, let's say you're a smarter trader and you're aware of SPX index options. Now, with SPX options, the headline is you'd only need to buy 10 SPX index put options to accomplish the same purpose as your 100 SPY options. So let's analyze why that is. You see, the SPYs are priced, as I'm sure that most of you know, at almost exactly 1/10 of the size of the SPX. So if SPX is trading at 3,000, then the SPY will be trading right around 300. So a 20-point drop in the SPX from 3,000 to 2980 is the equivalent of a 2-point drop in the SPY to 298. So let's say the SPX does just that and drops 20 points from 3,000 to 2980. If you own 10 SPX options, then they would pay the owner of the put $10,000 when they get settled because the market fell 10 points below where the put gets activated, and we own 10 of those. Now, that drop of 20 points by SPX would be accompanied by a $2 drop in the SPY stock to 298. So a 299 SPY strike put could be sold for $1 at the end of the day because it gives you the right to sell SPY shares for $1 more than they're worth in the market. So the 100 SPY puts would be worth $10,000 at the end of that day. In other words, 10 SPX put options gives you the exact same amount of value as the 100 SPY put options. Yet round-trip commissions on your SPX options would be $20. $10 to buy and another $10 to sell, assuming $1 per option, versus $200 for your 100 SPY options, again assuming $1 per option. That's a ridiculous waste of money that can be avoided if you simply know how to divide by 10, which I'm pretty sure all of you do. So what I'd like you to take away from this video is the fact that for virtually every tradable index, there's an ETF that represents that basket of stocks. The ETFs are usually worth 1/10 of the point value of the indexes, and so as long as you're trading with enough size, it never makes sense to buy SPY options when you could buy 1/10 of the number of SPX options and pay 1/10 of the commissions as well. My apologies out there to the retail brokers, but we're just trying to give the little guy a little edge here. Now, just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that our traders use, including the really simple strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. If you're interested, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open up the free registration page in a new window, or you can just go ahead and head over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And one more thing I'd like you to please do is go ahead and click our subscribe button so you don't miss any of our trading videos produced for the trading and investing community. And while you're at it, add some feedback. Just write up your comments in the comments section. for what videos you'd like us to produce next, as well as what you found helpful from this video. So from all of us here at SMB, trade well.